of a company. I mean, in US, the companies are like Coke and all this, Coke, IBM, and a whole lot of these blue chips. They are close to 100 years or maybe even more than that. So longevity is very important. Now, there's a small quiz. Power of compounding works best over the long term. 4 million times in 70 years. Does this number kind of strike anything? Big number, but CAGR is only 24%. What is this? Warren Buffett has compounded his initial capital of $10,000 in 1940 to 40 billion in last 70 years. And he has compounded the rate of only 24%. So in 70 years, if you do your numbers, 24.24 or something will come. $10,000 will become $40 billion in 70 years if you compound at the rate of 24.24%. 4 million times. And this old man is still kicking, and he's more passionate about investing than us. And if he's 81 years old, if he stays another 10, 12 years, which he will for sure, I mean, God is great on him. So he is going to be a guy who will multiply his money maybe 10 or 15 million times. So this is the power of compounding. If you stay with the stocks, high quality stocks, you cannot stay for very long term, even 10, 15, 20 years, forget about the 70 years. Even if you want to stay 10, 15, 20 years, you can't stay in bad companies. You have to necessarily buy quality companies. And third is the growth, which is the pet subject out here. I mean, I looked at a few companies. I looked at Domino's, I looked at Coca-Cola, IBM, and Nestle. These 4 companies I checked in Bloomberg. In last 20 years, what has been the growth? The growth is at the rate of 4 or 5% in their total sales, compounded in last 20 years. And if you, because of their buyback and maybe some margin expansion, they are great companies. They have grown at about 10, 11%. 10-11% in last 20 years. So, so growth. So Rakesh has come. Now I think investing will gain a little more momentum. So growth is another aspect which is missing in the developed world, and India is one country where a lot of growth is ahead. We talk about next $1 trillion opportunity, where I mean it took 60 years for the country to come to $1 trillion. It took another 6 years to go to $2 trillion, and $3 trillion will come in 3 years or 4 years. $4 trillion will come in 2 years, and $5 trillion will come in maybe another 2 years. So maybe because of all these problems, it may take another 1 or 2 years. But this particular 10 years, which China has enjoyed, in 1998, China became $1 trillion. By 2008, it became a $6 trillion economy. So this is a very, now China cannot go from 6 to 36 in next 10 years. But India has this unique advantage of going from 1 trillion to 5, 6 trillions in next 10, 12, 15 years. So this is unique growth opportunity, and this growth, of course, the small companies, new companies, they will also grow. But the blue chips, on the back of these blue chips, the old entrenched companies, you are going to see the growth happening for the entire economy. I don't think you can grow without the help of L&T or Tata Steel or Reliance or Nestle or, most of these companies, they have to be at the forefront to manage the growth. Of course, they'll be on the sides, new companies will come up, internet-based businesses will come, private sector insurance will come, banks will come, so all kinds of companies will come, but this is one opportunity of growth. So if you combine the growth and blue chip status of the companies, I think you're going to get, without much problem, very good portfolio returns. Fourth is the low risk, which I talked about. High return, but significantly low risk. If you look at the 20-year CAGR of Sensex is 15%, blue chips is 24%. This itself is, and this is not a, we have not picked in, we have not selectively picked up Nestle or Hindustan Lever or anything like that. All kinds of companies, whatever they have done, all the 48 companies put together is 24% in last 20 years, and Sensex has done 15%. But the real thing is that standard deviation for Sensex was 68%, so volatility of return has been 68% per year, and blue chips is just about 34%. So you not only got double the return, and let me tell you what is the impact of 15% in 20 years and 24% in 20 years. 15% in 20 years is 16 times. 15% in 20 years is 20 times, sorry, 16 times. 4 times in 10 years, another 4 times. So 16 times in 20 years. But when you do 24%, it is 73 times. That's the gap, 73 times in 20 years. And that too at half the volatility. So it's a tremendous thing. It's like almost 4.5 times of what you could get from the Sensex. So what is a blue chip investing process? Only 2 steps. Understanding the quality, which is very easy. Everybody knows what is a blue chip. I mean, you don't, of course, we'll define it statistically and we'll use the proper screen. But intuitively, everybody knows what is a blue chip. So understanding quality is the main thing, but that is very, very easy. I think the real problem is recognizing the value of blue chip. You know, how do you recognize, how do you understand that blue chip is available at reasonable prices? So we'll look at both of them carefully. So we use a 6-screen approach for coming out with blue chips in India. I mean, this is the screen used by in US to define the blue chips. Here we have used with a limited data, slightly lower data than what is available in US. In US, you can do 25 years kind of data. Here we have 20 years. So the first screen is for 3,000 companies. We said 20 years uninterrupted dividend. Every year, every single year, you must give dividend. So from 3,000, only 133 companies come. There are only 133 companies which have given dividend every single year. Then we said dividend raised, I mean increased in 5 out of 12 years. Out of 12 years, last 12 years, because 12 years is a number where you can complete one business cycle of one boom and bust. So that they've decided about 12 years. We have also taken 12 years. 5 out of 12 years. So that is 106 companies. Then earnings growth in 7 out of 12 years. That brings it down to 76 companies. Then fourth screen, average 12-year ROE is about 15%. Is only 68 companies. Then the last screen is that minimum, fifth screen is minimum 50 lakh shares. 5 million shares should be standing so that there's a liquidity, you can buy, sell, price is efficient and there is some liquidity. So that makes it again 68 companies. Then we said there should be at least 80 institutional investors on every stock. So here we get the data about various schemes are treated as, say like if ICICI has 5 schemes, L&T is in 5 schemes, so they'll consider as 5 sets of investors because individual shareholders are different or unit holders are different. So like that, we found only 48 blue chips confirming all the 6 criteria. And these are the blue chips, and we have, so we have not used any price filter. We have not said that any company which has made 20% is the blue chip or anything like that. No price filter, only fundamental, kind of performance filter. So Titan is, Rakesh, Titan is 4th number with 41% compounded for last 20 years. So congratulations on having in the portfolio a Titan. I mean, to see it at that point of time. When did you buy Titan? I think you held it for almost full 20 years. So here is the great guy who bought Titan and made all the money, 41% in last 20 years. So, yeah, Sesago also, Madhusudan Sumi, Havels. I mean, these are not, see, one of the things is that, yes, these are blue chips now, but if you look at 10, 15, 20 years back, they would have not qualified as blue chips. I mean, today it is confirming as blue chips. So, some of these companies like, say, HDFC or ABB, CRISIL, another ones, 28% compounded, SBI, 28% compounded, Asian Paints, they are acknowledged blue chips. Even then, in 90s and all, they were blue chips. So, and you can see most of the known names, which it will be coming up at different, so Wipro is actually in last 20 years, sorry, last 12 years. The price CAGR is for last 12 years. Wipro is a company which is a blue chip, clearly blue chip, but because of the purchase price in 1999-2000 was extremely high, maybe about 1.5 lakh crore or something like that. That has brought down the rate of return to 1% only. So clearly we have not used any price filters for judging the blue chips. These are the acknowledged blue chips. There are some more blue chips, which are about 20 more blue chips, which have got listed little later, say things like TCS or HDFC Bank, and there are a whole lot of about 20 companies, Axis Bank, I think ICICI would also come in that. So there are 20 companies which is on top of this 20. So I would say about 65 to 70 companies are acknowledged blue chips in India right now, as per this definition. What are the characteristics of these blue chips? Longevity. Median age of 48 blue chips is 57 years. There are 8 companies above 75 years of age. There are 44 out of 48 companies have dominant positions in the respective businesses in which they operate. Then you have very concentrated business. Now what happens is that in businesses where there are 2 or 3 players, like in, say, in two-wheeler, there will be just about 3 players. In paints, there are only 3 players. In a lot of these businesses where 2 or 3 or 4 players. So that limited competition and the market dominant position is the lethal combination for these companies to keep making money without disturbance. And out of 48, 23 companies are consumer facing and 6 are financials. So there is a lot of dominance of Colgate, Hindustan Lever, Nestle, Titan, whole lot of these consumer facing companies are because consumers remain same. Industrial requirements can change, there can be cyclicality, but consumer demands, like whether it is an Asia paint or whatever, they keep remaining same. And we have 120 crore Janta, and there are a lot of aspirant people to consume a lot of this FMCG products. So I think the journey is going to be long, and growth will be there, and some of the leaders will be very, very predictable. And high quality of management, reflected by the average ROE for the blue chips compared to BSE 500 or BSE mid cap. Now the second problem, which is the main problem, everybody knows that quality companies should be in the portfolio, and everybody dreams to have this company in the portfolio, and yet nobody has. Most of the guys, even in my portfolios, maybe 60% or something would be in blue chips, but there would be still a lot of companies which I would not like to call it blue chips. So, most of the people have a lot of companies which are not blue chips. So, one of the problem is that when you look at the company, suddenly you look at the P multiple is very high. And we think that if we buy at 40 P multiple, one cannot ever think of making money. These are large valuation, very high valuation. How do we make money? So I think we have to understand this P multiple a little more intensely. I used to be thinking like that, but dividend yield, if you just look at the small formula out there, dividend is equal to D by P. You divide the D by E and P by E, so it becomes D divided by P, which is nothing but payout by P. So P is equal to payout divided by dividend yield. So once your payout is very high, the businesses which are giving you 70-80% payout, they are necessarily going to be high P companies. Growth is one side of it, but high payout leads to high P. This is what I was not knowing, and then we stumbled upon this particular formula, and when we looked at it in Damodaran and all, they've given the full derivation. P is function of growth and payout. And we used to be much more focused on to the growth, but not so much on the payout. So clearly, one has the companies which have, so like Lever, which never grew and didn't return also a lot of money, but they remained at very high P multiple, purely because of the fact that the payout ratio was 80%, and even if you take 3%, which is very high dividend yield, divide 80 by 3, 25 to 30 P would be the minimum P for a sustained 80% payout company. And that's what really happened with the Hindustan Lever in last 10 years. So I think one has to be extremely careful about this dividend yield. And we have some more examples where high payout is clearly leading to higher P. And if you go to the Gordon's formula, P is equal to D by K minus G, this is a little complicated, slightly complicated. Again, as the G goes, the multiple can go very high. So the higher the payout and higher the growth, the higher should be the P. But higher the growth and higher the P, that we knew, but higher payout playing such an important role, that at least I was not aware of. And that you must keep in mind when you are paying high P for some of these blue chips. So, and you have seen that in last 20 years, Nestle has given 23% return, and at the beginning, in 1991, the P multiple for Nestle was 64. Today it is 42. You bought at 64, you are selling at 42, still you made 23% return. So, I mean, you can see what a growth can do, what a dividend can do, and what high P. I'm not saying that one should necessarily buy into high P, but to understand value of these companies, you have to intellectually see why these companies are little higher priced in terms of simply in terms of P. Because the companies which pay out bulk of their earnings by way of dividend, those companies clearly the investors they love it. People think that majority opinion determines the share price. Never. In the stock market, prices are not determined by majority opinion. Mukesh Bhai cannot determine the price of Reliance. Price of Reliance or any stock is determined by only marginal opinion. The people who are holding 100 shares, 200 shares, they decide the stock price. And they like cash dividends. Dividends in their mind has too much of value compared to earnings in the books. Because the promoters, they are very happy to have the earnings in their books, because for them the books and their own book is same. Whereas for the minority shareholder, what pays out is what they get. They have bought the stocks for the dividends only. So the guys who pay more, that earning translates into higher P multiple. And we did this for all the companies here, and we found that all the 100 companies, if you look at it, higher the payout, higher is the P multiple. Yeah, this is another one. You know, I had bought a company called Birla Corp. So company is much more profitable than even ACC or Gujarat Ambuja. And look at it. Payout is 38% for ACC because Holcim took over. They immediately changed the payout ratio. And they are enjoying today 14P, whereas Birla Corp, which has a 12% payout, their P multiple is just about 5. They are struggling with 4-5 times. And ROE, I mean profitability of the company, Birla Corp is at 38% despite paying low. So it has done brilliantly. But yet you get very low P multiple because the payout is very low. It is very, very clear example of what a payout can do to the P multiples. So in blue chips, when to buy? Now this is the main issue. Ps are directly related to payout and growth. Dividend yields are more structural and homogeneous. You see, the funny thing is that dividend yields in all the blue chip type large companies is not more than 1.5 to 2%. It is extremely sensitive. You raise the dividend by double. What will happen is the P yield will come down to 1.5% and the price of the stock will go up. So yield is very, very structural. It will never be more than 1.5 to 2% in the entire market you can see across. Blue chips are likely to trade at throwaway price. Blue chips are never likely to be traded at very low prices due to superior quality, high ROE, high payout. So the focus on buying at reasonable valuation, not necessarily cheap by conventional measures. You will never get it by conventional measures very cheap, these blue chips. So as Buffett says, we try to invest in outstanding companies at sensible prices rather than in average companies at bargain prices. So blue chip investing is a very different, what you call, discipline. You have to bring that patience, you have to bring that discipline of understanding value and buy into those companies, not looking at only P multiples. I'm not saying that 40P is the right for any company, but you got to get into calculation of why P multiple is 30, 35. So you have to look at growth as well as payout. So we put this two filters. Current dividend yields higher than long period median yield for that particular company. The company's own median yield you have to look at, not look at the Sensex dividend yield, because every company has its own profile, and current P lower than its own median P, because every company has its own growth profile and own payouts and growth ratios. And second signal is any company which has, any blue chip companies which has more than 3% dividend yield. 3% is a lot of money for a blue chip. So we came out that currently these are the companies which look to be reasonably cheap to buy. Hero MotoCorp with 5% dividend yield, Blue Star 3.9%. This is a great company right now facing adversity in terms of contracts and actually incurred loss in last quarter. But tremendous track record in terms of last 20 years what they've done. Infosys, Wipro, TCS, all three of them are looking to be, they don't have, their payouts are about 30-35%. They're sitting on a lot of cash. Infosys is sitting on about $5 billion of cash, and they are finding reasons to pay out as much as possible, as quickly as possible. So, but they don't have a dividend policy proper. I spoke to them, and they said, I mean, even Wipro said they don't have a very well communicated dividend policy, but they have, of course, very clear intentions of paying it out. So they can pay out as much as 50-60%, which will lead to their almost doubling of the P multiple. I think we'll definitely go and meet them and speak to them. Then you have Wipro, Cummins, Tata Steel, Madhusudan Kela, Ashok Leyland, Bharat Forge, Exide. These are the companies which look to be by these filters and all. So any company which you understand any one of them, I think these are the stocks to look at. But most prominent looks to be TCS, Infosys, Wipro as a category, and Exide. These are the stocks which I understand I would like to look at for investing from current levels. Then when to sell? I think the issue is it works best for the buy and hold, but at extreme valuations, like what happened to Wipro Infosys in 2000. At that time, you must exercise and you must sell. Extreme valuations are known. It's only the greed when people don't sell at those prices. And in these companies, it is known. I mean, you sell at 100p. I mean, the stocks are at 100p. It has gone up by 10 times, 20 times in just 2-3 years. So I think one has to be extremely careful in those extreme valuations. And let me tell you, even if you are not sold in extreme valuations, you are not completely out of money. You can still get some sensible price out of these blue chips, despite committing mistake. Potential blue chips, that's the another one. I mean, Rakesh got Titan as a potential blue chip. I mean, I think he bought it like in tons. I mean, he bought it literally at throwaway prices, 30, 32. The guy was giving discount to buy more quantity of Titan than what he wanted to buy. So he literally got it free. So are there any other Titans at about 30, 32 bucks? I mean, some of the, we have put again filter on the same lines for last 5 years, because these have to be young companies. Uninterrupted dividends for 5 years, increase in 3 out of 5 years, dividend increase in 2 out of 5 years, ROE less than ROE not less than 15 years in any of the years. This is a very difficult filter. And 5-year PAT CAGR of 10%. And dominant player, huge size of opportunity, component management. To best of our knowledge, we have come across these companies which are less than 10,000 crores market cap, and we have put out 28 companies for your reference. Wherever you connect, you know about them, and you think that they have a longevity and long-term possibility. These are companies to find your few emerging blue chips from where you can have a lot of multi-baggers coming out in the years to come. Just 1 minute on to concept of minimum dividend obligation. I think in India, what has happened is dividend is misunderstood and not given that much care by the minority shareholders as well as many managements. And payout ratio has been pathetic. I mean, out of 2,100 companies, 942 companies have payout less than 10%. 400 companies have payout less than 20%, about 15%. And only 600-700 companies have payout above 15%. And all these companies, about 1,700-1,800 companies out of 2/3 of the companies are in all the retail portfolios. All the retail portfolios are having these companies. So they are suffering from very low P multiple and low dividend payout. So and you see the low payout. India is amongst the lowest in the world. I mean, worse than us is only Russia, which is 12%. Otherwise, we are by far the lowest payout companies. And minority shareholders don't have any rights under the company law. And this is good. I mean, this is in the lines of UK and US, but we don't have investor activism. So one of the suggestion is we should have a minimum dividend obligation by law, company law, or maybe SEBI guidelines or something. So whereby minority shareholders can get at least some dividend out of the companies, because companies are not just paying out. They think that in a lot of companies, even big companies, I went and they said, if you want return, why don't you sell the shares? I mean, they're crazy guys. So, you know, the only way they learn is there should be some legal status to put dividend obligation on them. Maybe it could be 33%. In Brazil, by articles, if you don't have a dividend policy, by default it is 50% payout. You earn 100 rupees, you have to pay out by way of dividend 50 rupees. So, you know, Brazil's payout ratio is 40%. Even Pakistan payout ratio is 49%. So, I think we need to look at it, and we'll speak to, we spoke to the journalists and all, and I'm sure Rakesh is also going to take it up with I mean, he can talk to anybody. So, in conclusion, financials have emerged as the largest wealth creating sector. Very fast growth in stock prices create transitory multiplicators. One has to be extremely careful to have them in the portfolio, particularly if it is of suspect qualities. Blue chips are fountains of dividend and offers as much, if not more, investment growth potential than lesser quality companies with far less risk. In investing, there is no profitable substitute for quality. Understanding quality of company doesn't stop at profits and profitability. It must extend to dividend payouts and longevity of the company. Most blue chip companies enjoy premium valuation. In deciding when to buy, one should focus not only on PE, but also consider payout, relative dividend yield, and earnings growth potential of the company. In India, over the last 20 years, all the blue chips put together, these 48 companies, have significantly outperformed benchmark indices with much lower risk. Thank you very much.
Thank you, Mr. Agrawal, for a very thought-provoking and insightful presentation on blue chip investing. And I, for one, can definitely take back a lot more lessons from what blue chips are and how we can profit from them, even though I'm not going to invest in Pakistan yet. With that, I think we're going to move to our next session, which is the panel discussion. Over the last 12 months, stock markets have been very challenging, especially given the policy inactivity, the volatility in global markets, and uncertainty that we've seen in almost every investing category across the world. In these troubled times, we have to bank upon our panel of experts today to crystal gaze into the future. With that, I'm going to invite our eminent